Welcome to another video. Dividend investing is a time-tested strategy that appeals to individuals looking to build wealth steadily over time. It focuses on purchasing stocks from companies that regularly distribute a portion of their earnings to shareholders in the form of dividends. By reinvesting these dividends and holding the stocks long-term, investors can benefit from compounding returns and financial stability. Let's break down the key elements of dividend investing for long-term growth. Let's get started with the video. Breaking down dividend investing for long-term growth, understanding. Dividend investing. Dividend investing involves selecting stocks that pay consistent dividends, typically from established companies with a track record of financial health. These payments are often issued quarterly and represent a share of the company's profits. Dividends provide investors with regular income, even during periods of market volatility, which is why this strategy appeals to those seeking predictable returns. Benefits of dividend investing. One of the primary benefits of dividend investing is its potential to generate passive income. Investors can use this income to cover expenses or reinvest it to buy additional shares, increasing their portfolio's value over time. Dividends also act as a hedge against inflation, as they often grow alongside company earnings, maintaining purchasing power. Another benefit is the stability of dividend-paying stocks. Companies that consistently pay dividends are usually well-established, with strong cash flows and a commitment to returning value to shareholders. These factors often make them less volatile compared to growth stocks. The power of dividend reinvestment. Dividend reinvestment plays a crucial role in compounding wealth. By automatically reinvesting dividends to purchase additional shares, investors benefit from exponential growth in their holdings. Over time, this strategy accelerates portfolio growth, even with modest market returns. For instance, an investor who reinvests dividends in a stock yielding 4% annually could see their total returns substantially outpace those of an investor who only collects the dividends as cash. The reinvestment strategy capitalizes on the power of compound interest, making it a cornerstone of long-term dividend investing. Identifying high-quality dividend stocks. Choosing the right dividend stocks is essential for achieving long-term growth. High-quality dividend stocks typically exhibit characteristics such as a strong dividend yield, a sustainable payout ratio, and consistent dividend growth over time. A sustainable payout ratio, which measures the percentage of earnings paid as dividends, is a critical factor. Companies with a payout ratio below 60% are often more reliable, as they retain enough earnings to fund growth while maintaining their dividend payments. Dividend growth is another vital criterion. Companies that regularly increase their dividends demonstrate financial strength and a commitment to rewarding shareholders. The dividend. Aristocrats, a group of S&P 500 companies that have increased dividends annually for at least 25 years, are prime examples of high-quality dividend stocks. Balancing yield and dividend growth. Investors often face the challenge of balancing high dividend yields with sustainable dividend growth. High yields may appear attractive, but they can be a red flag if the company struggles to sustain its payouts. Conversely, stocks with lower yields but strong dividend growth may offer better long-term potential. For example, a stock with a modest 2% yield but annual dividend growth of 10% could outpace a high-yield stock with stagnant payouts over the long term. Assessing a company's financial health and growth prospects is critical in achieving this balance. Diversifying a dividend portfolio. Diversification is essential for mitigating risks in dividend investing. A well-diversified dividend portfolio includes stocks from various sectors, such as consumer goods, utilities, healthcare, and technology. This approach reduces the impact of poor performance in any single sector on the overall portfolio. Geographical diversification can also enhance a portfolio's resilience. Including international dividend stocks provides exposure to different economies and currencies, potentially boosting returns while reducing risk. Tax implications of dividend investing. Understanding the tax implications of dividend investing is crucial for maximizing returns. In many countries, dividends are taxed differently based on their classification as qualified or ordinary dividends. Qualified dividends often enjoy lower tax rates, while ordinary dividends are taxed as regular income. Investors should also consider using tax-advantaged accounts, such as individual retirement accounts in the U.S., to shield dividend income from taxation. These accounts can help accelerate portfolio growth by enabling reinvestment of pre-tax dividends. The role of dividend ETFs, dividend-focused exchange-traded funds, offer an alternative to individual stock selection. These funds provide diversified exposure to dividend-paying stocks, simplifying portfolio management for investors. Dividend ETFs are especially appealing for beginners, as they minimize the need for extensive research and stock analysis. Popular dividend ETFs, such as the Vanguard Dividend Appreciation ETF and the iShares Select Dividend ETF, focus on companies with strong dividend growth and consistent payouts. These funds offer an efficient way to participate in dividend investing while reducing individual stock risk. Monitoring and adjusting your portfolio regularly. Monitoring a dividend portfolio is essential to ensure it remains aligned with investment goals. Factors such as changes in dividend policies, company performance, or sector trends can impact the portfolio's performance. Investors should also rebalance their portfolios periodically to maintain diversification. Rebalancing involves selling overrepresented assets and buying underrepresented ones, ensuring the portfolio remains optimized for long-term growth. Risks associated with dividend investing. While dividend investing offers numerous advantages, it is not without risks. Economic downturns or changes in a company's financial health can lead to dividend cuts or suspensions, potentially impacting income and total returns. Additionally, over-reliance on high-yield stocks may expose investors to companies with unstable financials or declining growth prospects. A disciplined approach to stock selection and diversification can mitigate these risks. Staying committed to the long term, patience and discipline are vital for success in dividend investing. The true power of this strategy lies in its ability to generate compounding returns over decades. Investors should resist the urge to sell during market downturns and remain focused on their long-term objectives. Staying informed about market trends, company performance, and dividend policies ensures that investors make well-informed decisions. Over time, the combination of consistent dividend income, reinvestment, and capital appreciation can lead to significant wealth accumulation. For more videos, like and subscribe to our channel. Thanks for watching the video.